You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is time once again for TWIFO, This Week in Futures Options, the program where we break it all down on the futures options side of the fence. What's going to make it on the show? You have to tune in every week to find out. My name is Mark Longo from theoptionsinsider.com. Reminding you, if you're one of our legion of on-demand listeners, then all we ask that you keep rating and reviewing new folks discovering the network all the time. Coming off yet another record month for the network in our 15-plus year history. So thanks to all of you who have been a part of that. And we want to keep that ball rolling. So if you like what you hear, keep rating and reviewing. Really does help the new folks discover the content. And of course, if you want to go above and beyond, join us for great live community, live access to all the shows, exclusive content, including a double dose coming up tomorrow, pro Q&A, and options oddities coming up right after ball views. You know where to go. As well as giveaways. We just gave away a great pro trading crate just a few minutes ago. You know where to go. Theoptionsinsider.com/pro is the place to go to begin your journey to the dark side. I need to put that /dark side there as well. I've been busy and a lot of fun stuff going on there. A lot of fun stuff going on the show today. And joining me to help me break it all down today, our old friend, you know him, you love him, Dan the Man Gramza, the president of Gramza Capital Management. Dan, welcome back to TWIFO, sir. It has been too long.
Well, thank you very much, Mark. It's great to be with you. I'm really excited about looking at these markets today. A lot to talk about.
A lot to talk about indeed. So let's kick it off the way we always do. It is time for the Movers and Shakers Report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, welcome to the Movers and Shakers Report, the portion of the show where we break down everything lighting it up to the upside, a.k.a. the light side, and to the dark side across the broad spectrum of tradable products. Over there at CME this week, Mr. Dan, you know what comes next. Where are we beginning our journey this week? To the light side or to the dark side?
I'd like to start with the light side.
You do seem like a light side kind of guy, Dan.
I am.
I think a blue or a green lightsaber for you, not so much the red. I'm more of the red guy. But yeah, we actually have some. We have a mixed bag actually this week, which is kind of interesting. We've been kind of biased in one direction or the other for the last couple of weeks. This week, it's kind of back to closer to 50-50 here. So to the light side we go. The light side does seem like it's the weaker of the two this week. So intriguing stuff. Let's get to the bottom of our top five. Let's go to silver. By the way, of course, this report, one of the few premium reports you guys can get access to over there at Bantix without being a premium user. Bantix.com, Bantix.com, gets you access to not just the TWIFO reports. We give those away for free, but you get access to these reports and a whole bunch of other great stuff, pricing sheets, spread builders, open interest reports. I could spend an hour just going through all the features here on Quick Strike. Check it out for yourselves. Bantix.com is the place to go. And if you did that, you can run this report for yourselves whenever you wanted. Like you can see right now, number 5 is silver to the upside, up 1.34%. Number 4, the Russell 2000 back in the top 5, this time up 1.6%. Number 3, S&P just barely outpacing the Russell 2000, up 1.63%. Number 2, back to the metals, it's gold, up 1.88%. And number 1 this week with a kind of mild bullet, let's call it a 22, it's the NASDAQ 100, up 3.61%. It was number 4 in the other direction last week, off a whopping 0.15%, because last week it was all green. So we couldn't really find a lot of red to make it bottom 5 last week, hence the NASDAQ barely squeaking in there. All right, now to the bottom of our movers and shakers we go. Let's see. By the way, our frequent offenders, haven't seen any of them yet. Our frequent offenders, we got Bitcoin, we've got lumber, and we've got nat gas. Let's see if we can find any of those bad boys today. Number 5, to the dark side, SRW wheat. Rough week for the wheat, off 6.12%. Number 4, off to energy we go. It is heating oil, off 6.51%. Number 3, staying in energy, we got WTI, old friend WTI, off 7.27%. You know, nat gas has been stealing all of WTI's thunder of late, but this week, WTI fighting into the number 3 spot. Number 2, still hanging out in energy. It's RBOB, off 8.77%. It was number 3 in the other direction last week, up 8.5%. So it's kind of unched over the last 2 weeks. And before you get excited, less than 1,000 contracts on the tape for RBOB. And then number 1, the only one of our trifecta hitting the movers and shakers this week, the only one of our frequent offenders, it's lumber, off 9%. It was number 1 in the same direction last week, off 10.35%. So a lot of the weakness in the housing market being reflected here in lumber taking it on the chin. Our old friend Sean, too bad he wasn't still on the show. He could build his fence now for a fraction of the cost of what it was when he was conducting Fence Watch. Well, Dan, given the fact that we've got heating oil and WTI and RBOB all lighting it up in the dark side, I think we have to begin our journey in energy first.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, everybody, welcome to the world of energy. You know where to go to find those reports for yourself, cmegroup.com/TWIFO, TWIFO. Once you're there, go into that asset class, scroll down 3, go past ags, go past crypto into energy, then you go jump over to crude oil in the product family, then to the top of the product list for WTI. That's where we will begin our journey this week. I know we had some people requesting energy this week as well, so there you go. You folks are happy. If you guys have a product complex you want us to hit on the show, you know where to find us at Options on most of the major social media platforms. If you're one of our pro listeners listening live, you can hit us up there as well. Of course, we tend to listen. We're a good listening bunch of folks over here on the network. So if there's a crazy product you want us to break down, as long as it does some paper, you can't really do oats, does like 3 contracts, but as long as it does some paper, we'll see if we can squeeze it onto the show for you. All right, Dan, a lot going on in the world of energy. What is lighting up your tape this week, sir?
Well, I think, Mark, we have a few of them, and you mentioned them, that I think are interesting. If we start with crude oil, let's start with that one. And what we're seeing, I think, is a market that could even get a bit weaker. I feel like we're coming down to what fair value should be for crude oil. I wouldn't be surprised actually to see it in like a $10 range, 85 or $15 range to 100 over the next few months. We have a few things going on dynamically, I think is being reflected in the prices that we're seeing for that market. Excuse me, and they're not too surprising in some ways because energy markets absorb a lot of the factors out there. And plus, the other thing that has a big impact, I think, right now across the board is perception. We're looking at a market that in crude oil, it's the lowest it's been since February when Russia invaded Ukraine. And I think people are coming to the realization that higher interest rates, global economic slowdown, it's going to have an impact on demand. And that's part of what we're seeing. Our U.S. stockpiles last week grew 4.5 million barrels. So that has an impact on the idea of expectations, I guess is the way to think about it. And, people are driving less. What I find interesting is that they're driving less this summer compared to 2020 when we had all these pandemic restrictions. So this increase in price has had some impact at the pump and at people's perception about do they want to spend the extra money to take that trip. So I think that's reflected there. Also, we're not seeing OPEC responding to Washington's request to increase production. They're talking about raising like 100,000 barrels a day in September. That's, and they're saying they're near limited spare capacity. I don't think Saudi Arabia is. Maybe and United Arab Emirates, that also is one that I think there is probably some more room. But if you look at the U.S. producers, and we hear so many people saying, they're terrible. Look at all this profit they're making. Well, I think what you need to look at is not just now, but you need to look at the last year or two. If you look at ExxonMobil, and I'm not recommending ExxonMobil, I do have it in my portfolio, but they were spending billions of dollars when they were losing money for infrastructure. The complaint is that in the United States, we haven't built a new refinery since 1974. And that's true. But we've increased our capacity, production capacity in terms of refining by over 50%, because the cost to get a new refinery in place is incredibly high. And you got all the regulation and you have the time. It takes years to do that. So what we've seen is that current refining operations have been expanded, and either using new technologies or just expansion of the production capabilities. So the industry, from my point of view, has responded. They've also lost, again, ExxonMobil, they lost billions of dollars. In fact, they borrowed billions of dollars to do some of this infrastructure spending. But I guess the other thing, Mark, is if you and I were an oil company and we're supposed to increase our production in terms of refining, okay, and the cost to do that is significant, and it's not going to happen overnight. So by the time that new capacity could come online, we have an administration who's already said fossil fuel is bad and we don't want to keep it. So what happens to my investment? Am I doing the right thing by my shareholders to build excess capacity? So, there's a lot of challenges here when we think about the energy market. And I think those are a few of the pieces that come together. But that there's also one more, and that is the U.S. dollar. the U.S. dollar gets stronger, then oftentimes crude oil prices, energy prices will come down. And that has an influence there. And the reason it does is that crude oil is traded in dollars. So if I'm in a country that I now, actually I did something with Ghana, the government in Ghana, and we looked at cocoa. They're in the band around the equator that cocoa and coffee's grown, gold, crude oil, and then their currency. So they have the seed. So now I get paid in U.S. dollars. I go to my bank and I turn those U.S. dollars into my currency. Well, if the U.S. dollar is strong, I get more of my currency. If the U.S. dollar is weak, I get less of my currency. So the idea being, if the U.S. dollar is weak, we want crude oil prices to go up to offset that currency exchange rate. And what we're seeing now is the U.S. dollar has been fairly strong. So I think it's another component that gets added to the entire energy complex. The only other one that marches to the beat of its own drum is natural gas. And that's one I think we should really pay attention to. Longer term, I think there's more room to the upside for that particular market. So I think we have more possibilities for that moving higher. For crude oil to go sideways, maybe down to $85 a barrel, I don't think is unreasonable. But if you and I look at nat gas, getting a move back up above $9, I don't think that's out of the question for that market. We want to see it staying above 752. Ideally, by the end of this week, we'd want to see it closing around 870, 880. And by the end of next week, we'd want to be above 950, 960. Now, that would be a market that's going up the way it came up previously. If it doesn't do that, if it doesn't meet that kind of criteria, I'm looking for a sideways move in nat gas.
All right, Dan, a lot to unpack there. Let's get to it out here, listeners. I mentioned already how to find a WTI in the list here. Pull up that drop down. If you see that, you'll see coming into showtime, we're at right around 88.5. So again, as Dan mentioned, levels we have not seen in quite some time out here in WTI. Again, are you buying what Dan's selling? Do you think we have more downside to come? The market certainly seems to be telling us that's the case out there. In terms of action, we got kind of about an average week on the tape, maybe a little bit light. So usually around 400 something thousand. We're at about 384,000 right now in WTI. And in terms of the vol, by the way, of that 384,000, 41% coming in the SEP contract. It has about 13 days to go. It's right around our cutoff point, listeners, so we can hang out there. Why not? The vol, 45.88, up about 2 points. So again, compared to a lot of the products you folks trade, like a lot of the equities out there, it's pretty frothy, pretty volatile, but also not quite at its apex from a vol perspective. In terms of skew, last week the puts were almost 4.5% rich, about 4.4%. This week they're coming a little bit. They're 2.9% bid. So again, that's nearly 3% premium, listeners, above that already nearly 46 at the money vol level there. So if you want to buy your proverbial 25 delta put, that's the vol level you have to pay. The calls, they were 2.6% cheap last week. This week, 2.2% cheap. So if you're going to buy or sell a 25 delta call, that's going to be 2.2% discount to that at the money vol there. In terms of the most active contract, I said we're at about an 88.5 right now. It looks like it was the 90 puts in September, doing almost 11,000 contracts this week. Those were the big dog, trading pretty actively all week. The big day was Wednesday, 3,700 contracts on Wednesday, 2,600 on Monday, 2,500 on Tuesday, 1,900 today. Looks like it's been back and forth opening and closing, which is not that surprising. We've been flirting around that 90 strike all week. So as we flirt with it and then retreat away from it, you're going to see more opening and closing paper around there as a result. Right behind it, we have the 85 puts as well, doing 10,600 contracts, just a couple of hundred contracts shy. Looks like on Wednesday there was some vertical action because the numbers on the 90 puts and the 85 puts were almost identical, about 3,700 for each. So probably some vertical action. And then 3,300 on Monday for the 85 puts, and then 2,800 today. So pretty active day today. Less than 1,000 on Tuesday. And then we jump over to the 105 calls. They did almost 10,000, 9,980 contracts so far this week. The big day for them, Tuesday, 3,800 on Tuesday, 3,300 on Wednesday, 1,600 on Monday, and 1,200 today. Again, back and forth on opening and closing. The 85 puts, they were opening all week long, so a little bit different there. So a lot of puts, a little bit of calls lighting it up out here. What we're not seeing are those weird 1 point wide verticals that were going up last week that were really driving up the numbers to crazy degrees. I'm not seeing those, at least for any appreciable size out here this week. If you want some weirder prints, how about the 150s in Dece of 2024, listeners? Those were trading, and they traded pretty much all week long. 1,500 on Monday, only 20 on Tuesday, then 1,100 on Wednesday, and 3,600 today. Total of 6,200 of these going up this week, and no real other vertical legs to speak of. So someone is just opening on the 150s, I should say. I think I said 1,500s earlier. The 150s. Someone is opening on the 150s all week long here in Dece of 2024. What do you think? 150 by December of 2024? What do you think about that level, listeners? What does that imply for the broad economy as a whole if we are at 150 by December of 2024? Intriguing stuff out here. Dan, before we roll out of energy, really quickly, you mentioned nat gas. You know, nat gas and WTI kind of vie for all the headlines in the energy space these days. But I mentioned some other names here that get a little bit less interest. Got RBOB at number 2 off nearly 8.75%, and heating oil number 4 off 6.5%. Obviously, they're smaller products from an overall options volume perspective as well, which is why they don't make it on the show too often. But I'm curious for your perspective as you're watching the energy complex, Dan. Do RBOB and heating oil come into your crosshairs ever, sir?
They do. And if you look at RBOB right now, which is gasoline, it's doing what it should do. It's kind of marching to the same beat of the drum as crude oil. As those prices come down, we expect to see this to weaken as well. And remember, we have that lighter demand, which can have an impact here. So we're seeing, I think, that reflected here. Lower levels here wouldn't be surprising. I think that 270, below 270, 265 by the end of this week could be expected. Actually, that's tomorrow. So to see that kind of move going into the end of the week will be interesting. You know, something for us to watch on RBOB, mentioning Friday, is this. That how it closes, not only RBOB, but the entire complex, how it closes on Friday, I believe is a measure of market confidence. In other words, right now we're trading around 278 in RBOB. If we close lower and close near its low, then that says to me that people are willing to hold a short position going into the weekend. And as you know, Mark, these futures, as all the markets do, stop Friday afternoon. And futures begins 5 o'clock Chicago time Sunday night. So we don't have to wait till Monday. But are people willing to hold that position until Sunday night? If they are, it says something about the momentum, and it says something about people willing to commit to a position. Now, let's look at the other side. Let's say tomorrow in RBOB, we do trade down to 270 or a little bit below, but we close back up towards 280. In other words, on a candle chart, you'd see a big shadow on the bottom. I call it behavioral candles because I define some things a little differently, but to me, that would represent buying. Now, that could be the people who sold RBOB for the last 2 days are now buying it back because maybe they're not confident going into the weekend. Or has RBOB gotten so cheap that people are willing to open positions? They're willing to buy a vertical or a call as we go into the weekend because they think it's cheap. The key to that tomorrow, when you and I see that, will be Monday's action. If we see a market that closes on the low, we're looking for 5 o'clock Chicago time Sunday night for our Bob to stay weak. That's Asia. Asia starts to trade. So we want to see that downward pressure, that they still feel the same way. On the other hand, if we have a shadow on the bottom and Sunday night we open up and the market heads back down, that would imply profit taking on Friday. If we don't see that, if Asia opens up on Sunday night and we see the market now starting to work its way higher, and by the time the European session starts, 1 or 2 in the morning Chicago time, if we're working towards 290 or 285 to 290, that would imply we've gotten low enough to find buyers. So I think Monday for these markets could be an interesting barometer. Not only Monday, but Friday. How do we finish Friday and how do we start out on Monday? And, heating oil, which is also an interesting market, with that market, you're looking at jet fuel. It's not as weak as gasoline. It's held its own. It is at a level around 330 where we found buyers before. And so the issue now is, are they going to come back in? Are we going to see their presence tomorrow? They're not there today. And if we don't see a close near that 325 to 320, chances are we're going to go more likely in a sideways move.
And in case you're wondering, listeners, heating oil doing a whopping 1,311 contracts this week, and RBOB 450 contracts. So unfortunately, neither of those going to make it on the old program today, outside of what you just heard. Instead, we're going to keep rolling right on into another big hitter, frequent offender here, at least on this week's dark side. It's wheat. So let's get to the ags next.
It's time to get our hands dirty exploring the latest options, trades, and trends in corn, wheat, soybeans, and more. It's time to talk ags.
All right, everybody, welcome to the ags. You know where to go in that drop-down, listeners. Pop out of energy. Go all the way up to the top of the asset class list. It is an alpha order list, after all. And then we're going to go to grains and oil seeds, and we're going to pop down. Usually we hang out in corn. This week we're going to pop down one to SRW wheat, a.k.a. Chicago wheat. If you're wondering, how does Chicago wheat stack up to KC wheat? As of right now, KC wheat has 7,800 contracts on the tape. And as of right now, SRW wheat exactly 10x, 78,000 contracts on the tape for SRW wheat. So a little bit more action in that Chicago wheat, which is also on our movers and shakers list this week. Dan, we mentioned earlier crude oil kind of retreating back to levels we have not seen since the Ukraine invasion. The other big story coming out of the Ukraine invasion was, of course, what's going on with the wheat supply over there. So wheat being buffeted around by Ukraine over there. What are your thoughts on what's going on this week in the wheat and in the ag, sir?
Well, I have to tell you, Mark, wheat, it fascinates me. It fascinates me because of where we are price-wise. And you think about what's going on. There is a lot of wheat that's been harvested that's sitting there, millions of bushels. And we've had the first ship that was with corn that was able to leave Odessa. So Russia and the UN and everybody said, okay, yeah, we'll let some grain coming out. That wheat coming out of Ukraine is critical for many countries. It's 1/2 of the wheat program for the was it the World Food? No, it was one of the World Trading programs for people. In other words, it's 125 million people that are involved in getting fed by this organization, and wheat is a big part of that. And wheat from Ukraine is over 50%. If you look at the Arab countries, wheat is critical. Making bread is a big deal. When we think about the Arab Spring, that started with the cost of a loaf of bread. And so it's an essential part for that part of the world. And they get a big chunk of that from Ukraine. But now, here are some challenges. We have this wheat, let's say, that's already been harvested. All right. And if they do open shipping, that will make a big difference. Now we can start moving it. Up until now, they were trying to look at river ports to move some of it. That's limited. They talked about moving it by rail. That's tricky because Ukraine has Russian dimension rail lines. The rails of the railroad is wider than the European standard, so you really can't do that. You can get it there, but then you got to offload it, and it's messy. So this wheat, in terms of where it fits in, is critical. Now, let's talk about something else. What about this past spring? We know that parts of Ukraine did get out there in southern Ukraine to plant, because you had wheat, you had corn, you had sunflowers that were being planted. Well, can they harvest it? Who's going to harvest it? Did they have the fertilizer they needed for those products? That was very expensive and hard to come by. So did they plant as much? There are some farms that have been mined by Russia. So do I go out there? Some farms have been bombed. We see these big craters when you look at the pictures. So who's going to harvest it when you have people going into the army? And if they harvest it, are they going to be able to send it out? So the situation there is not finished by any means. And that's why this market befuddles me. Because you would think wheat would be back where it was not that long ago. Back in May, we were over $12. It's trading at $7.82 today. So we're a long ways away from that. We're also at levels, if we look at wheat, watch that 750 level. It's where we found buyers just a few weeks ago, and it's where we could find them again. It looks like we are, and that is a market. If indeed that is true, then that means we should be trading above 820 to 830 by Wednesday of next week. We'd want to see that kind of follow through. The critical piece would be a close above 850 by the end of next week. If we saw that kind of movement, then we have a chance maybe for a rally. If we don't, then I'm looking for a sideways move. So that market has some challenges ahead. When we think about that, the other biggie too is Mr. Corn. That's a market that 60% of the corn to the EU, it comes from Ukraine. And the same issues are there. Who's going to harvest it? How much carry out do they have from last year? How are they going to transport it? All those issues come into play for this market as well. And we are at levels that are relatively cheap for this market. Right now, we're trading where we were in March. In February of last year, we were just a bit below this. We were around 5 something in February. That was, I can tell you, around 590. And we're at 602 today. We got as high as $7.80, I think it was, 770. Yeah, around 780. And now we're trading at 602. This is a market we could also get that long-term bounce from. But here are some critical things that you and I want to keep in mind, I think, references that we want to think about. Just like with wheat, there are certain performance that you want to see in this market if indeed we're going to get follow through. The big number for this market by the end of next week would be a close above 635. So not just trading above it, but a close above it. If we get that, then further movement could occur in that. The next big level is going to be 665. So if we move higher, we want to see it right away. And this is another market, Mark, like we were talking about. How do we finish this week out? Now, if we finish tomorrow closing above 610, that's a step in the right direction. it tells us that people are willing to hold on to corn. If we close back towards 580, it says people are exiting before the weekend. If we have that positive close above 610, then that 630 becomes the magic number by the end of next week. If we see that kind of commitment, then the chances are we may have gotten cheap enough to find those buyers. And that's where we want to do what you do, is to look at those options. How are they priced? Who's doing what? Are they opening positions? Are they closing positions? To give us some clues about what we need to do when it comes to that market. And another one that I find interesting, and that's our friend Mr. Bean, soybeans. Soybeans have been relatively high if you look at where it's come from compared to wheat, for example. I would expect the other markets to act like we see when it comes to soybeans. Now, soybeans back in February were around $13.50 a bushel. They went up to, and again, it goes back to June, about the same time frame as all the other ones, to about $15.85. And right now, we're around $14.17. So it did pull back. It has a very similar technical setup that we just looked at in corn and in wheat. The big numbers that I think that you and I want to pay attention to see how the market moves. And this is the strongest right now out of all these grains that we've talked about, these markets. And you'd want to see a close above 1440 ideally tomorrow. And you'd want to see a close above $1,500 or $15, excuse me, by next Friday, because that means we're going out the way we came in. I want you to know this market can have that type of volatility. In about 5 days of trading, we went from, what was that, 1314 to 1489. So we can get some movement. Beans can be volatile. And the critical part of this is also going to be soybean oil, which is in competition with sunflower oil. And that's about 10% of the cooking oil we use globally. And 75% of sunflower oil, where does that come from? Our friends in Ukraine. So we're seeing these markets having an influence on each other. So we're seeing competition. If you're going to look at oil, for example, soybean oil, you want to look at palm oil out of Malaysia. That Indonesia is the largest producer of palm oil. And so you want to watch that. That's also traded on the CME group compared to soybean oil. Sunflower oil also, it's more critical than people realize. So, steps are taken in the right direction globally right now for the Ukraine situation, but we're not out of the woods. I think these markets, we're going to see some ramifications. So I guess what I'm trying to say is I'm bullish on these markets. And I think the next week or two is going to give us some insights in terms of what we can expect.
All right, let's get to it, Mr. Dan. Getting into the wheat, listeners, of course, get into the ags, grains, and oilseeds, and then one down below corn for SRW wheat. 78,000 contracts on the tape right now, like I mentioned earlier. Wheat right now, 781 and 3/4 off. 26 handles are about 3.2% just since Monday's show. Of course, you go back to last week's show, we're off over 6%, 6.12% to be precise. So a lot of weakness out there in wheat right now. In terms of the vol, what is the vol of wheat? Let's find out. By the way, 57% of that 78,000 contracts going up. And the SEP contract has about 22 days to go. We're going to hang out there. The vol in that expiration cycle is a 42, down a little over 5 points on the week. So again, still pretty frothy, certainly when you compare them to a lot of your equities and the other products you're going to trade. A 42 is nothing to sneeze at. In terms of skew, got a bit of a weird skew. Last week, the puts were exactly even. They were 0.0%. So no premium, no discount. They were exactly even with the at the money, which meant that put skew was flat, listener. That's kind of weird. You don't see that too often. This week, they're 3.7% cheap, so a little bit of a discount. Last week, the calls, 5.1% bid. This week, still around that same level, 4.8% bid. So we have a little bit of a skew shaping up, and it's the opposite of a skew that you would see in a lot of your traditional equities and other products that you trade often. It's a bid to the calls and a discount to the puts. It's kind of the inverse of what we see in a lot of the other products out there. In terms of action, let's see, the most active contract this week, we are at a 781 3/4. It was the 900 calls that were leading the dance with about 7,000 contracts on the tape this week. So closing in on 10% of the paper going up in these 900 calls in September. Pretty active all week long. Looks like people were closing them all week long, which is kind of interesting. The big day was Wednesday, 2,753 on Wednesday, pretty much closing. Tuesday, 2,400, also closing. Today, 1,000. Obviously, we don't know about today's OI. And then Monday, about 800, also closing there. So closing on the 900s all week long. That's kind of interesting. Followed right behind it, we have the 800. So maybe a bit of a roll down. Let's see, because we were opening on the 800s all week long. So has a bit of a whiff of a roll down to it to me, listeners. Let's see, the big day for that also Wednesday. It doesn't line up exactly 1-to-1, but it's pretty darn close. Again, there's about 2,000 less contracts. There's only 5,003 of the 800s versus about 7,000 of the 900s trading this week. The big day, Wednesday, 1,978, 1,200 on Tuesday, 600 on Monday, and about 1,100 today. Interesting stuff. It lines up pretty close, so it has the whiff of a roll down, and when you see closing on one, that's pretty far out. Opening on something that's closer to the at the money. It makes a wee bit of sense why they would be taking off those 900s now. Outside of that, just closing the 900s now seems a little bit odd. Let's see. Then what else do we have lighting up the tape? Then the tie for kind of third with the 850s, the 750 puts, and also the 900 calls in December, all doing a little north of 3,000 contracts this week. So intriguing stuff out here in the week, but we're coming up against it, listeners. Let's get on out into the land of equities next.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody, welcome to the equities. We have an embarrassment of riches in the light side equities this week. The S&P, the Russell 2000, and the NASDAQ all dominating the light side this week. You guys know where to go to find the equities for yourselves, listeners. Pop on out of ags, scroll down a few slots, go past crypto, go past energy to equity indexes, then go to US Index E-mini. We're going to hang out there first in the Russell 2000, where our journey takes us after that. We shall see. Before I break down the numbers, Mr. Dancer, what is catching your eye and lighting up your tape in the actually, before we get to that, I'm getting ahead of myself, listeners. Before we get to the equities and all that fun with Dan, we have to also set the tape from a vol perspective. Can't talk equities without talking the flip side of that coin, which is vol. Let's kick it off with the VIX of the Russell 2000, RVX, about 26.5 when we kicked off the show, down about a third of a point. So not a huge evolution on small cap vol. The VIX itself, a little bit shy of 22, 21.95 when we kicked off the show. That's also down a little more than a third of a point. So VVIX, the vol of vol, right around 84 to 85 range. That's actually up about 4.5 points from where it was this time last week. And vol Q, so the at the money vol, the NASDAQ 100 at about a 26.20, down about a quarter from this time last week. That puts that VIX to RBX, so the large cap to small cap vol spread at about a 460. That's about a tenth of a point wider, but pretty much in line with what it was this time last week. A same deal for VIX and vol Q, so the S&P to NASDAQ vol spread about a 4.25. That's about a tenth of a point wider there as well. So we're kind of hanging out in relatively the same vol range this week that we were last week. Not surprising, not a ton happening. And also, we got non-farms tomorrow, so everyone's kind of keeping their powder dry ahead of that. All right, Dan, we've set the table. What is catching your eye out there in the land of equities right now, sir?
Well, you know, that, your last comment there, I think, is the key to today's action, which is relatively quiet. If you look at the S&P, if you look at all these, they've made new highs and they backed off a bit. Here you see shadows on both sides when you look at the candle charts. The one that's really balanced is the Russell. Right now, that's really in a neutral position as we go into the close in an hour or so. So we're seeing some action here. I think that's reasonable. There's a lot of institutions that I've worked with in Europe and other parts of the world that when it comes into this kind of number, if you look at the price action on the chart, you'll see it kind of converge, kind of get quiet. And some of the banks that I would deal with is that they go neutral going into those numbers. They don't want to have a strong position, or they may already have a position long, let's say, for example, and they're not willing to add to it or back off from it, but just hold steady. And I think today's action is showing us that they're really waiting to see what these numbers are, because what do these numbers do? Well, it has a possible impact on what the Fed may do, right? And that perception of what the Fed should or shouldn't do is also what we see in the market. Everyone's concerned, including the Fed, that if they increase interest rates too much, we are going to be in a recession. And some people say we are in a recession based upon, the two negative GDP quarters that we've had. Other people say, no, you got to allow for what's happened in the first quarter to unusual circumstances to say that we're in a recession. However you look at it, what we do know is that when the Fed starts increasing interest rates at some level, and this is the tricky bit, nobody knows what that level is, including the Fed, the market will start to run into a recession possibly. The demand, the credit starts squeezing down tight enough that the economy slows down. And for us, we need the consumer. It's 70% of our GDP. And something that affects consumer sentiment, consumer spending, they're a big deal, because that is what drives our economy. That's the backbone behind our economy. And if we look at late 2000, remember we had the dot-com bubble. And if you look at March of 2000, and if you look at interest rates, at that high, interest rates was 6.5%. And then we started coming down. The Fed said, holy Toledo, we'll start lowering the interest rate. They lowered it to 1%. And then it started working its way back up. Why? Because the Fed's saying, inflation, we could be having inflation. So they increase interest rates to try to calm that down. And in 2007, 2008, we got, I think it was 5.5%. And at that level, subprime mortgages could not be paid. And the result is we saw that whole thing start tumbling down. And that happened to be a rate that created that. We know if somebody's paying an adjustable mortgage at some rate, if they can barely make that payment, they will not be able to make the payment. And that was at 5.5%. So the market came down and the Fed went down to zero. Remember that? Now we're working our way back up. So that's why the market's so sensitive here. So I think the price action that we're seeing coming into tomorrow's numbers makes sense. For me, and again, this doesn't mean anything, but I have a positive bias right now for these markets. If we start with our friend, Mr. Russell, that really is a unique indicator because it is those small to mid-cap companies. If buyers are here, I believe what you and I would want to see on Friday, and it goes back to that Friday issue. Are people willing to hold on to these positions? Are they willing to add to these positions? Do we see a close above 1920, ideally towards 1930? Holy Toledo, if we get that, that says people are willing to hold a position. We're looking for follow through. And again, 5 o'clock Chicago time, Sunday night, is when that market starts to trade again. The one that I think is kind of the weakest out of today is the Dow. It's relatively quiet. It's inside yesterday's range, but it's a typical setup. So there's nothing unusual there. The NASDAQ did make some new highs. We have earning reports that have come out that I think help support these markets. Earnings are a barometer, I believe, of a factor that creates market belief. If earnings are coming out strong, that means that people are willing to buy those products, that they have capital, they're willing to spend it. And that's good fuel for our economy. But we also want to remember that indices like the S&P 500, 45% of their income comes from outside the United States. So it's a very interesting look at what creates this market movement, I think, in these indices. I do look for follow through. I'm looking for a strong close as we go into the end of the week. In the Dow, the magic number here would be getting a close as close as possible to 33,000. In the NASDAQ market, 13,400 to 500. In the Dow, 4180 to 90 would be the ideal kind of close for tomorrow, which says commitment going into the weekend. So it's a very interesting setup, Mark, but I think the markets are acting reasonable in light of the numbers we have coming out on Friday.
What fun are reasonable markets, Dan? We don't want reason. We want madness and mayhem, and maelstroms abound.
You're probably onto something.
All right, we'll break down these reasonable markets. If you insist, Dan, ever the reasonable fellow that you are. Russell 2000, let's see, looking kind of light. Again, everything's looking kind of light in the equity space right now. Everyone's keeping their powder dry, as Dan just said, ahead of the big announcement tomorrow on what's to come out here. It's only about 14,000 contracts on the tape in Russell 2000 land this week. By the way, Russell 2000, 1908.60 right now. So starting to flirt again with the range of around 2,000. I remember when Sean was back on the show, he was so excited when the Russell 2000 broke 2,000. He wanted to have a Russell 2000 at 2,000 party. And then, of course, all the COVID fun happened and other things took precedence. Maybe if we get there again, we'll have to revisit that out there. 1908 right now, 23 handles, about 1.25% just since Monday's session. So a lot of this green we're seeing on the movers and shakers for the week has come this week, listeners, in the equities. In terms of vol, like we just broke it down, by the way, 51% yet again of that paper going up in the contract that goes out tomorrow. So we got to scroll out a little bit to find some paper. It's a little bit longer term. Let's go out to September. That has 43 days left to go on that contract. By the way, the vol out there about 24 1/3, up about 1/4 point. So kind of hanging out, kind of within a spitting distance of what we're seeing out there in RVX. I just broke down. That's about a 26.5. In terms of the skew, last week the puts 14.1% bid. This week 14%. The call is 10.3% cheap. Last week 9.8. Again, not a lot going on. Everyone's waiting for the big news tomorrow, listeners. And in terms of action, like I mentioned, it's almost all going out tomorrow, and it's all the 18.5 puts. So 50 odd handle out of the money puts doing 1,500 contracts this week. So over 10% of the paper is on these 18.5 puts. The big day was Tuesday, 1,111. That's a weird number, 1111 going up on Tuesday, 200 and change on Wednesday, 200 and change again today, and a whopping 9 on Monday. Opening all week long, so opening on the 18.5 puts all week long. You know, if past is prologue with a lot of these equities, they were probably selling those, but you never know given everything that's been going on out here. 1865s also traded about 1,000 times. Looks like we maybe have some verticals, even though they traded about 500 times on Monday as well when nothing else traded on the 18.5. So it wasn't all 18. It wasn't all verticals. It was also just some straight up opening paper on the 1865 puts as well. So a lot of put action. If you add up the 1850s and 1865s, you got 2,500 contracts just in those alone. So making up a good chunk of the paper out here. And Dan, we're kind of coming up against it, but we got time for one more complex. You're our guest. I'll let you pick, sir. What final complex should we squeeze onto the show right now, sir?
That's a tough one. The currencies are interesting. We talked about the eggs.
There are a lot of metals on the light side this week. You want to go metals?
Yeah, let's go metals.
All right, to the metals then we go, listeners.
Werewolves beware. It's time to explore the options activity in silver, gold, and other shiny things. It's time to talk metals.
All right, everybody. We had gold at number 2 this week, up 1.88%, and silver at number 5, 1.34% On our movers and shakers, Mr. Dan, sir, what is lighting up your tape in the shiny stuff this week?
Well, I for gold, I would say, and silver, it's about time. If you look at the way these markets have behaved, it's not as expected. Gold and silver, precious metals to me, and platinum are in that perception category. They need an excuse. I call them excuse markets. So, for example, in gold, uncertainty can drive gold prices. Why? Because people take their money and they feel that there's value with gold and it's going to hold its value no matter what happens. Okay. Well, I think the invasion of Russia into Ukraine, it's kind of a period of uncertainty. We don't really know what's going to happen. Gold hasn't really responded to that. It's come down. If you think about where it was just a few months ago, and right now, what we're seeing today is it's starting to respond. Now, let's talk about some other factors. Inflation. In times of inflation, high inflation, you expect money to flow towards gold. A weaker dollar, you expect money to flow towards gold. And today, we're actually kind of seeing it. It started the week out with the gap higher, very unusual behavior for this market. But we are seeing follow through today, and that I find interesting. The numbers for this market right now, what we'd want to see tomorrow, ideally, is a close above 1820. That would tell us that those buyers, again, are willing to commit to the weekend. The market that's also been a little more resilient is the silver market. That's a market, but today, that's a market we've seen pretty good response. But today, we're not seeing it. Silver's very quiet, actually, very balanced. We're not seeing the same level of commitment that we've seen with gold. So that's more of a neutral setup going into the numbers. It does have a bullish bias. Both of these markets do. So the sentiment, I think, in the marketplace is for higher prices. The issue is their paper behind it. So fundamentally, I think it favors higher prices. Price action in silver seems a little muted. Gold is responding today. And if we look at one other metal, it's not a precious metal, a base metal, and it's copper. Now, the issue with copper is that China consumes about 48% of global copper. And the issue is also with their COVID things they had going on that it may dampen demand. And we've seen that. We've seen copper starting to respond last couple weeks, but it's been a very weak rally as it's moved higher. And then just as of the last few days, it's backed off. Today, it's got a bullish setup. And in this market, it would imply, again, if we're going to move higher, if we're going to see these buyers respond, then we really want to see it. We want to see their presence in the marketplace. And you'd want to see it close above 360, ideally by the close of Wednesday of next week. For tomorrow's action, we want to close above 355, right in that range. That would tell us that, again, people are willing to hold on to this market as we come into the weekend. But Mark, here's the thing. Do we have fundamental drivers to support that? Are we going to get the paper coming into this market to support that? So fundamentals, I think, are so-so. Price action is bullish. It does imply an update tomorrow. So it'll be interesting to see if we get that kind of follow through in Mr. Copper.
All right, let's check out the metals here really quickly. Hang out in gold. It is the most active. 152,000 contracts on the tape right now. That's not blowing the doors off for gold, but like a lot of things, it's kind of drifting right now. Of course, the shiny stuff getting a bit of a lift earlier this week with Pelosi's much heralded, much condemned trip over there to Taiwan. Of course, people tend to have a flight to quality in times like that, which is another reason why gold getting a bit of a lift, hanging out at the 1800 level right now, listeners. And in terms of that 152,000 contracts, 25% exactly going up. And the SEP contract has about 21 days to go. We're going to hang out there. Gold vol right now, 1492, an excellent year. Not so great on the vol front, but I guess we'll find out. Up about a third of a point. In terms of action, the puts last week, 0.8% bid. This week, 0.2. So not a heck of a lot of put skew last week. The calls, 2.2% rich. Last week, this week, 2.4. So the calls remain where the bid is. The puts, kind of not a lot of action in terms of skew there. And in terms of volume, the big dog this week looks like it was and I take it back, the 18 halves were active in September, but it was the 2000s in October. The 2000s in October leading the dance with 8,200 contracts this week, listeners. The big day today, 3,600 today, 3,100 yesterday, 1,300 on Monday, and a whopping 84 on Tuesday. So not a lot of action on Tuesday. Followed right behind it by the 19 halves, 6,700 of those. Again, same deal. 3,300 today, 3,000 on Wednesday. So probably some verticals, 19 half, 2,000. And then not much going on earlier in the week. So looks like 19 halves and 2,000s were trading pretty actively yesterday and today. And then right behind it, we have the 18 halves going up in September. They did 6,151 out there. The most active day for those was actually Monday with about 3,000, most of that closing. And then 1,300 on Tuesday, slightly opening. And then 1,700 today. We don't know the OI there today. So maybe some rolling action of the 18 halves from September out to October. But it doesn't seem like it doesn't line up from a day perspective. So looks like more just a similar but unrelated paper here, listeners. All right, and that music means we have come up against it yet again, listeners. Wow. We packed a lot of living into today's show. We went across a bunch of complexes, went out to the ags, went out to the metals, went out to the equities, spent a lot of time in energy, even talking about some products we don't always get to sink our teeth into in energy. So hope you folks had a good time, learned something. If you have a complex or a product you'd like us to discuss on the show, hit us up. We're pretty nice folks over here. If it does some paper, we'll see if we can work it in for you. And before we go, Mr. Dan, if folks are intrigued by anything you laid down today, they want to reach out to you or maybe explore your content in more detail, where should they go? What should they do?
Well, they could go to dangramza.com. It's a website that I do a daily review of the markets. I do it on 22 markets on stock indices, currencies, interest rate, metals, energy, and ags, like you and I talked about today, Mark. And it's a daily review on a swing chart. So we're looking at daily charts. The concept is that would go from 1 day to maybe 3 months for a concept of a position. You'll see red and green lines, which represent buy and sell levels. These are not buy and sell recommendations. I'm just trying to share with people how I would look at these markets. And if you've never traded futures, a place to begin is watch them. So you can sign up for the free video. You can watch that as long as you want. And you can go back in time. You could go back 7 years and see what was I saying when Russia invaded Ukraine if you want. And you can see how these lines change over time. So that just provides that kind of reference. Or if you only trade stock indices, maybe you want to look at these currencies or the energy markets like Mark took us through today. Well, those are included, as you can see, markets that I pick out for a daily discussion. So that's, a place to try to get some additional information. And if you have a question for me, there's a support tab there, and I'm happy to answer any question you may have. That'll get to me. There's another way to do that too.
There you go. DanGramza.com, GRAMZA.com is the place to go. And of course, to go check out all of these reports in more detail. CMEGroup.com/TWIFO is the report, or I should say is the place for all that goodness. And last but certainly not least, where do you go for more info on all things small caps? It's FTSERussell.com, FTSERussell.com. Give them a follow on the old Twitter while you're at it, at FTSE Russell all one word. That's going to do it for us today, but don't worry. Back again tomorrow live, noon Central, 1 p.m. Eastern, to break down the mad week that was and indeed will be tomorrow with non-farms on volatility views. That should be fun. Then after that, we've got options oddities for all you pro folks. And then after that, pro Q&A with the once and future and now present Dr. Bix. A lot of you already getting your questions in. If you got a vol question, get them in. If you want to join the party, see what the heck's going on, theoptionsinsider.com/pro. And then we're back again next week, another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.